Mutual funds, index funds, and ETFs are three ways that you can quickly and easily invest your money in the stock market. Although they are similar, they have important differences. Oftentimes, people mislabel them, or they invest in them because they've seen their favorite influencer buying them without understanding what they actually are. And by the time they do, it's often a hassle or quite costly to switch between them. So in this video, I will help you understand what each of these three investing options are, the advantages as well as the disadvantages, so that armed with this information, you can decide which one works best for you. A warm welcome to all of my subscribers, and if you're new here, hello and welcome. My name is Jumoke and I am an investment banker turned early retiree. On this channel, I share some of the strategies that I applied to manage millions of dollars for some of my ultra high net worth clients. We also talk about personal finance, investing, as well as wealth creation. If this sounds interesting to you, do not forget to hit the subscribe button, click the notification bell so you do not miss new videos every week. Out of these three types of investments, mutual funds came first. Mutual funds were first used in the 18th century by a Dutch businessman called Adrian Ketwich, and his aim was to provide small investors with the opportunity to pool their funds together and invest in different assets. But the modern version of mutual funds as we know it today started in the 20th century, with the first mutual fund created in 1924 as the Massachusetts Investors Trust, which interestingly, after 100 years, is still in existence. So a mutual fund is an investment fund that collects monies from different investors to purchase or buy securities such as stocks or shares. When you invest in a mutual fund, you are buying exposure to those underlying companies. And so this is great if you are starting on your investment journey and you do not want to be bogged down by the single stock selection process where you have to pick individual stocks. And so a mutual fund can be a very beneficial platform to start with. Now, there are 5 main advantages of mutual funds. The first advantage is that mutual funds provide safety in numbers, i.e. they provide diversification. With just one investment, you can gain access to a wide variety of stocks, bonds, and other assets. That way, if one of the stocks within the mutual funds performs poorly or even crashes, you won't lose all of your money because you still have other stocks within the mutual fund, and these can perform so well that they actually erase the losses that you've borne from the poor performance or crash of that one stock. The second advantage of mutual funds is that they are so easy to buy and they also offer convenience. You can instantly own hundreds of stocks in one single package. So put another way, without mutual funds, you would have to buy individual stocks, pay the fees and commissions, and of course, pay the time that it takes to make those purchases. The third advantage of mutual funds is that they are managed by investment professionals. So you can have some peace of mind that your money is being managed by expert fund managers who research, select, and monitor the fund's investments. They also do the daily running of the fund and perform any analysis that is required. And this is great for beginner investors or investors that are very busy and don't have the time to actively manage their own portfolios. It saves you time and the headache of having to choose stocks by yourself. The fourth advantage of mutual funds is affordability as well as accessibility. It's really easy to invest in mutual funds. All you need is a stocks and shares account that has access to various funds, and you don't need thousands to build or own a diversified portfolio. Many mutual funds allow you to start with relatively low amounts, sometimes as low as $300 or even less on certain platforms. The fifth advantage, and this is a key one with mutual funds, is that they often offer the option to automatically reinvest any dividends or capital gains, allowing your investments to compound and grow over time without any extra effort. While mutual funds can be good options for investors, there are some disadvantages you need to be aware of. The first disadvantage is that mutual funds have a lack of real-time control, i.e. they lack liquidity. Unlike stocks that trade throughout the day, mutual funds are only traded once daily after market close. This means that you cannot lock in prices or react to market changes instantly during the day. So when you place an order to buy a mutual fund, that order will be filled after the market closes at the net asset value, i.e. the market value of the fund on that day. And so the fund managers wait until the end of the day to calculate this. The second disadvantage is that you have to pay the fund managers fees to manage the funds for you. And these management fees can eat into your returns over time. Mutual fund fees are generally a lot higher than those of ETFs as well as index funds. And this is because mutual funds have to be actively managed. That means the fund managers are actively picking stocks and making investment decisions, and all of that time and effort has to be compensated for. And so you're paying for that service as well as the general management of your money. But here is the kicker. Even if the fund doesn't perform well and the value of your money falls, you still need to pay management fees. Sometimes that is 1% or more of your account balance every year. So if you invest $5,000 and you are charged a management fee of 2%, $100 goes into the pockets of your fund managers regardless of how well your money performs. And over time, the cost of fees can really add up, and these can significantly reduce the growth of your investment, especially when compared to low-cost ETFs and index funds. And don't forget, a fund or a manager's past results does not determine their future performance. And so for some mutual funds, it is not worth investing in them when you consider the high fees charged. The third disadvantage, which unfortunately is one of the lesser known drawbacks of mutual funds, is their tax inefficiency, especially when compared to ETFs. Here's why. In a mutual fund, when a manager buys or sells stock positions, whether that is to rebalance or take profits, or to meet redemption requests from other investors, any capital gains generated on those transactions are passed on to all investors within the fund. That means you could owe taxes on decisions that you didn't personally make, even if you've only just bought into the fund or you didn't sell any of your shares. And so with mutual funds, you are at the mercy of the fund manager's internal trading activities. After mutual funds came index funds in 1976. That's more than 200 years after the first mutual fund was launched. The first ever fund is one that you may have heard of or maybe even own, and that is the Vanguard 500 Index Fund, which was created in 1976 by the founder of Vanguard, Jack Bogle. This fund, which is a type of mutual fund, was created to give investors access to the 500 largest companies in the US, but at a much lower cost than your traditional mutual fund. Now, here's an interesting fact. When this fund was first launched, it was nicknamed Bogle's Folly. And that's because, well, you always have naysayers, and there were critics who laughed at him and thought it was a very un-American way of investing. But to their chagrin, it completely revolutionized investing. And 50 years after his folly, Bogle's fund reigns supreme. There's a life lesson in there. So unlike traditional mutual funds, index funds are passively managed, which means you do not have to pay a professional to make active decisions on buying and selling. Index funds are set up to track specific indices, hence the word index in the name. And so they can give you an indication of how different stock markets are performing around the world. An index fund will always clearly specify which specific index it tracks. So for example, the Fidelity 500 Index Fund tracks the S&P 500, which it also calls its benchmark index. Another example is the UBS S&P 500 Index Fund, which tells you clearly that its investment objective is to track the returns of the S&P 500 index before the deduction of fees. It also tells you that the fund applies a passive investment strategy, which we talked about earlier. So if you wanted to know how the US market has performed year to date, you can look up an S&P 500 index funds to get a clear indication of performance. A major advantage of index funds is the very low cost they charge. Index funds simply buy whatever stocks are within the indices that they follow, and there isn't much decision making involved. And so that allows the fees to be significantly lower than traditional mutual funds that require active decision making. And they are great for beginner or passive investors who just want to partake in the performance of an index but don't want to do the work themselves. The main disadvantage with index funds is that they are not flexible. Managers cannot pick and choose what stocks are in the fund. And so it doesn't give a lot of leeway around structuring the fund for better performance because they just have to buy whatever stocks are in the index. Now, this is great when markets are swinging up and up and up, but it can be very painful when markets crash. Moving on to ETFs, or exchange traded funds. The first ETF was created in 1990 by the Toronto Stock Exchange. Now, ETFs are very similar to index funds with one major difference. Remember that index funds trade once a day after market close. But ETFs, on the other hand, trade like stocks, which means you can buy and sell them throughout the day. So let's switch over to the UK for an example. If you wanted to invest in the FTSE 100, better known as the FTSE 100, which is UK's flagship index and contains the largest 100 companies in the UK by market capitalization, you could go with a FTSE 100 ETF, such as the iShares Core FTSE 100 UCITS ETF. And there are many options, as you can see. ETFs, like index funds, are passively managed. And so the question you have to ask yourself is, do I require the tradability of an ETF, i.e. being able to buy and sell all day long, or am I content with trading once a day with an index fund? A major advantage of ETFs over mutual funds and index funds is, out of the three, it is the most tax efficient because it has what's called an in-kind creation and redemption process. And one of the most important factors to consider when investing is the consequences of taxation. And I made a detailed video on why ignoring this could cost you thousands or even tens of thousands over the years. And I will link it here and at the end of the video. The second advantage of ETFs is that you can buy as little as one share, whereas with index funds, the minimums can be higher and they can range between $300 to $3,000. The third advantage is that just like index funds and mutual funds, you get the benefit of diversification because you can have multiple stocks under one single ETF. The fourth advantage is that ETFs do not only cover indices like index funds do. They can cover a lot more strategies and sectors such as AI, technology, banking, real estate, utilities, etc. The first disadvantage with ETFs is that they can encourage trading as opposed to investing. Because ETFs trade like stocks, you can see them moving up and down during the day, and the temptation for impulse buying and selling is there. But when it comes to investing, you need to think about it from a long-term perspective. Human nature has a tendency towards gambling behavior, which is quite the opposite of smart investing. The second major disadvantage with ETFs is that many ETFs do not automatically reinvest your dividends unless you set it up manually with your broker, whereas mutual funds and index funds often automatically reinvest dividends, helping your money grow more efficiently without extra steps. So which of these three should you choose? Unless you want to day trade ETFs or you want the tradability of ETFs, most people will buy and hold until retirement because they are looking to catch the increase in the index over the long term. One big reason why a lot of investors choose index funds over ETFs is because of the automatic reinvestment process. Additionally, most index funds allow you to set up a monthly or a regular investing process where you deposit funds from your check-in or your current account into your trading account. And that amount is invested on your behalf at no extra cost. Also, index funds at providers such as Vanguard, Fidelity, and Schwab often have no transaction fees and no bid-ask spreads to worry about. And so to summarize, mutual funds will be more beneficial to investors who are looking to invest over the long term but want the active management or the active decision-making of an investment professional and do not mind the high fees charged for this service. Index funds will be more suited to passive investors who are investing for the long term but are not looking to beat the market, They only want to participate in the market at a much lower cost. And finally, ETFs will be more suited to investors who want the tradability of their holdings, who want to be able to buy and sell throughout the day at a lower cost. I hope you have a better understanding of these three investing options: mutual funds, index funds, and ETFs. Investing is a wealth building activity that is aimed at securing your financial future, but there oftentimes are very costly mistakes that beginner investors and sometimes seasoned investors make. And I posted a video on the top 9 costly mistakes that I see beginner investors make, and you can watch that next here. I will see you in the next one. Thank you for watching. Look after yourselves. Bye for now.